Ever wondered why your stocks or real estate values keep climbing, even when the economy feels a bit shaky? The answer might not be in the assets themselves, but in the money used to buy them. Today, we are doing a deep dive into a powerful economic idea, the weak dollar, strong asset theory. We'll break down exactly why the US dollar might be on a path to decline and how that mechanically forces the price of everything from stocks to gold to go up. Let's start with the why. What could make the dollar, the world's reserve currency, lose its value? Three major forces are at play right now. First, we have the fiscal dominance trap, or what I like to call the debt problem. The US national debt is soaring, approaching an incredible $38 trillion. To fund this, the government issues bonds. But here's the catch. Traditional big buyers like China and Japan are losing their appetite for this debt. So, who steps in? Often, it's our own central bank, the Federal Reserve. The Fed effectively prints new dollars to buy this government debt. And basic economics tells us when you flood the system with more of something, its value goes down. Each new dollar printed dilutes the purchasing power of all the others. Second is the trend of de-dollarization. For decades, the dollar was a neutral tool for global trade. But recently, it's been used as a weapon through sanctions and asset freezes. This has made many countries nervous. As a reaction, central banks, especially in places like China, India, and the broader global south, are shifting their reserves away from US dollars and into tangible assets like gold. In fact, central bank gold buying has hit levels not seen in decades. When global demand for dollars falls, its value naturally follows. The third driver is the Federal Reserve's classic dilemma. When the economy slows down, the Fed's go-to move is to cut interest rates to encourage borrowing and spending. But lower rates make holding US dollars less attractive for international investors, who can get a better return elsewhere. So, capital flows out of the dollar and into other currencies, pushing its value down even further. So, we have these powerful forces potentially weakening the dollar. Now for the most important part, how does this push asset prices up? It's all about thinking of money as a measuring stick. This is what's called the Denominator Effect. Imagine an asset, let's say a house, is worth a certain amount of real value, say 100 gold bars. If the dollar loses half of its value compared to gold, the price of that house in dollars has to double just to represent the same underlying value. The house didn't get more valuable in real terms. The unit of measurement, the dollar, just shrank. So, the number of dollars needed to buy it goes up. Then there's imported inflation. A weaker dollar makes everything we buy from other countries more expensive. Think about oil, electronics, or raw materials for manufacturing. This increases the cost of living and the cost of doing business. Companies have to raise the prices of their products to protect their profits. This can boost their nominal revenues and, in turn, their stock prices, even if they aren't actually selling more stuff. Finally, a weak dollar puts a giant for sale sign on American assets for the rest of the world. If you're an investor in Europe holding euros or in Japan holding yen, a falling dollar makes US stocks, real estate, and companies look incredibly cheap. This triggers a rush of foreign capital into the US markets. This new wave of buying demand from abroad naturally bids up the prices of those assets for everyone. Putting it all together, a combination of massive government debt, global political shifts, and central bank policy is creating a powerful headwind for the US dollar. And as the value of our money potentially erodes, the nominal price of hard assets is almost forced to rise in response. It's not necessarily a sign of a booming economy, but rather a reflection of a changing currency. Understanding this dynamic is crucial for anyone looking to preserve their wealth in the years ahead. Thanks for watching, and if you found this breakdown helpful, be sure to like and subscribe for more deep dives into the forces shaping our financial world.